Hi, good morning, viewers. This is PK Shikdar, and now I am going to discuss about Accounting Standard 3, that is AS3, which is termed as cash flow statements. Now, cash flow statement shows relationship between profitability and cash generating ability, and hence the quality of profits of the reporting entity. It is mandatory for listed companies and entities with a turnover exceeding rupees 50 crores. Cash comprises cash on hand and demand deposits with bank. And again, cash equivalents are short-term highly liquid investments that are readily convertible into known amount of cash and which are subject to an insignificant risk. Now, at this juncture, let me classify the activities on the basis of AS3. According to the revised accounting standard 3, the cash flow statement should show cash flows during the period classified by operating, investing, and financing activities. Now, let me highlight about operating activities. These are principal revenue producing activities of an enterprise. Other activities which are not investing or financing activities. Cash flows from operating activities generally result from the transactions and other events that determine the net profit or loss of the business. For an example, cash flows from operating activities are: number one, cash receipts from sale of goods and rendering of services, cash receipts from commission fees, royalties, etc., cash payments to suppliers of goods and services, cash payments of operating expenses such as salaries and wages, rent, electricity, etc. And number five, cash payments or refund of income tax. Now let us go to investing activities. Sorry. These are acquisition and disposal of long-term assets such as land, building, plant, furniture, goodwill, trademarks, copyrights, and investments not included in cash equivalents. Now I may highlight what are the items that will be included in your investing activities. Number one, cash payments to acquire fixed assets. Cash payments relating to capitalization of research and development cost. Cash received on disposal of fixed assets. Loans made to third parties. Cash received from repayments of loans made to third parties. Interest received or investments and income from investment. Now let us highlight the financing activities. These are activities that result in changes in the size and composition of owner's capital, including preference share capital and borrowings of a business. The examples are cash receipts from issue of shares, debts, bonds, loans and other borrowings, cash repayment of loans taken, cash payment to redeem preference shares, interest and dividend paid, etc. Now, what is the reporting formalities? Just now I am going to highlight the same. Net basis reporting is allowed in following situations. Number one, cash flows reflecting activities of customers rather than those of the reporting entity, namely deposits and withdrawals by bank's customers. And number two, cash flows in respect of items in which the taken over is quick and amounts are large and maturities are short, namely principal amounts relating to credit card customers, etc. And thank you. That is all about your accounting standard 3 cash flow statements. Goodbye.